Ladies and gentlemen of the crypto space, we are live on a Wednesday, 11:30 a.m., October 21st, and it is crazy. People are running around the streets. They got jello on and chocolate pudding. It's getting mad out there. Keep telling everyone to throw some vanilla ice cream in the mix, but they're fixated on their jello. It's literally, I don't even know where to begin. I have so many topics, so much hotness, so much awesomeness. So we're going to start, obviously, with what Lewis says in the stream, and that got me excited as well. That's a very good point, my man, and that is we need to focus on where to get good yield. We need to focus where to minimize risk. We need to consider the global financial macro perspective. We need to consider the central banks and the CBDC conversation. We need to consider Congress and stimulus. We need to consider everything because that is the only way to make the best portfolio decisions possible. What kind of balance do we have? What are our asset choices? And most importantly, how much money your assets are making for you, because your goal isn't just for your assets to appreciate in value, it's for your assets to work for you so that you could hopefully eventually stop trading time for money, aka work, aka that shit sucks. Then you can sit back and relax and manage your portfolio for the rest of your glorious years. All right, today's episode is sponsored by Change Angel, non-custodial swap exchange for social good. Absolutely the premier place to swap one asset for another because it's non-custodial, ladies and gentlemen. No deposits, no withdrawals. You send an asset, you get an asset. Now we're talking. Totally part of the DeFi concept. It is decentralized, input, output, or at least it's not custodial. Topic of conversation. What is DeFi? It's a conversation unto itself. Today's topic is Bitcoin breakout imminent, and who's did I really write that? who's give you crypto year? All right, guys, my coffee cup wasn't full enough this morning. Now the question really is, do I actually have the patience to fix that? Who's giving you crypto yield? All right, let's pop it over to the main screen and let's get this show on the road. And nobody focus on my typos. I swear, I got a couple of brain cells left up here. I'm not that old yet. Oh, I got so much stuff on my screen. I got pages overlapping. Oh my God, today's tweets this morning are absolute fire. It's absolutely crazy. And I'm not interested in being tagged on BNB. I have no interest whatsoever in Binance Chain, Binance Smart Chain. Thank you, Sentiment. Love you guys. Appreciate everything that you guys offer data-wise, but I'm so not interested in Binance Chain. Just don't care at all. Bancor, on the other hand, bam, V2.1. They're single-sided AMMLP pools. Absolute fire. Impermanence loss protection. Mitigating the impermanence loss problem. Now that is yield, ladies and gentlemen. That is protected yield. Now, obviously, we weigh our risk and reward, and these assets really need to be a small percentage of our portfolio, particularly because we go over here and we go to the Bitcoin dominance chart. And this is a reactive indicator, meaning this is kind of like bonds. This is the bonds of the crypto space. The bonds tell a story. They tell us that people are taking their value and allocating it towards bonds, even though the bonds are producing no yield. So that's a heck of a story. And can you imagine if they go negative yield and people still pile money in? That just shows you that there's no place to put money at all anymore in the legacy financial system. But look at what this story is telling us. This story is telling us that Bitcoin is exerting dominance over the rest of the crypto space, which means as Bitcoin shows its bullishness, which it really did with a $400 candle, and we're in for our first $1,000 daily candle. This is a $1,000 candle here. Clearly, it's not a full. Here, here's the daily candle. This is a $1,000 candle. We got it, boys and girls. So, but the story being told is Bitcoin is exerting dominance over altcoins, so altcoins are under extreme pressure, and they are depreciating in value substantially. Now, bear in mind that is uh, Bitcoin versus. So there are individual assets that are outperforming the rest of the altcoin market. And there's a lot to choose from. There's a whole lot of assets nowadays worthwhile to keep an eye on. Now, me, myself, everyone knows my story. Everyone knows the assets I'm looking at. I'm looking at the assets that are producing an ROI, that are hopefully producing an APY, which is compounded, which are producing at least a yield. Because the only thing worse than an asset doing nothing is an asset that doesn't produce a return on investment. Now, the whole question is how to get ROI safely, reliably, predictably, with minimized risk. Now, the appropriate thing to do is to diversify. Now, the prevailing trend, I'll digress a little bit in a couple of different directions. The prevailing trend, then I got to hit on Lewis's question, but the prevailing trend is over collateralized debt positions. If I give either a company, let's say BlockFi or Celsius, $1,000 worth of Bitcoin, or if I give Aave $1,000 worth of Bitcoin, or Compound, or Maker, I am able to have was it TVL? No, that's total value locked. It's LTV, loan to value ratio. So, for instance, DAI at MakerDAO is a minimum of like 150% collateralization, meaning if I want to borrow $1,000, I need to give them $1,500 worth of Bitcoin. Now, if Bitcoin drops in value past a certain liquidation threshold, they're going to sell my stuff to make sure the debt is made whole, or at least my debt position is collateralized effectively. So they're going to sell my debt position. They're going to liquidate my collateral. And that is why over-collateralized debt positions put almost all the risk on the borrower instead of the lender. Because the lender can always, especially if they have tweaked algorithms and very risk-adverse policies, if they're a centralized organization, they can always just liquidate the collateral to make the debt position whole. So the risk is placed on the borrower that their collateral position can be liquidated. Whereas if you have an under-collateralized debt position like a mortgage, if a borrower doesn't pay their mortgage payments, the lender has to take possession of an asset and try and regain funds. And they're going to lose money. They always do. But if I don't pay back my Celsius debt, if I give Celsius $1,000 and I borrow $250 and I don't pay back my 8% interest debt, they're going to sell my collateral to make the debt position whole. So they could always make the debt position whole, and that's the whole point, especially to the upside. So bear in mind it's dollar denominated. So if I'm getting, right now I'm getting like 6%, 5.9%, and they're selling loans for 8%, so they're getting 2% on a loan, which is an incredible business model. The only difference between the new age banking system that BlockFi and Celsius have with their risk pretty much eliminated, if not merely minimized, debt that's over collateralized, and banks do under collateralize. So banks assess risk. So what are the banks doing right now? Banks aren't lending at all. There's too much risk. And nobody has any collateral in the legacy financial system and then they wouldn't even accept over collateralized debt positions as a type of product. But crypto is overwhelmingly accepting over collateralized debt positions for leverage, so people can play with more money than they actually have, and that's the whole point. If I have $1,000 and I borrow $250, I have my original collateral and I have my $250. So that's the way the system works. And that's why, BlockFi and Celsius are a heck of a business. They've completely minimized their risk profile in a lending for profit business. Um, just by going the opposite way the traditional finance system has gone historically, just by only offering over collateralized debt positions, which really was made popular more recently by the likes in DeFi by MakerDAO, Compound, and Aave. Now, there folks are tempted, like Teller Finance is like a credit profile assessment, but by scanning blockchain history, and they're trying to get into like under collateralized debt positions. But I'm just fascinated by the over collateralized debt positions. So how do you get your yield? You diversify between Celsius, BlockFi. Clearly, where's so there's risk in that they are centralized organizations. I don't see any risk to the upside. Clearly, there's meaningful risk to the downside. If their algorithms or they don't liquidate fast enough, they could have a shortfall, a collateral shortfall, and then they have to do like an equity raise to compensate. But look, in March, when we had that massive risk off from the liquidity crisis, MakerDAO did a massive liquidation, and they had to do a raise, so they had to sell Maker MKR to get the peg back on the die. So this is a very similar mechanism that the centralized organizations, Celsius and BlockFi, have in order to maintain the solvency and the natural flow and function of their business model, which is basically give out loans for 8%, give people 6% interest, and take 2% for yourself. This is the most incredible business model. And if someone doesn't pay, they're just going to sell your collateral. Awesome. 11:42. I still haven't gotten to you, Larry Lewis. So yield farming at Curve. So Curve and Ren. Man, man, two different, completely different topics now, but they produce incredible yield. I love Ren. I think the macro narrative for Ren is that it fits into the entire crypto space as a cross-blockchain interoperability solution, and it's already proven the case between the Bitcoin UTXO blockchain and the Ethereum blockchain. Now, bear in mind, they're gonna be minting Bitcoin on Akala, which is a Polkadot substrate parachain, and they're gonna be minting it over in a Cosmos hub, no doubt. And but it's not just Bitcoin, because you got XDAI, who knows what's going on, and you got other types of bridges, and you got other types of cross-chain bridge solutions, the TBTC coming up. But I think the model that Ren has is overwhelmingly superior, especially not only from a product perspective, where if I want to get my equity, I want to access the equity in my Bitcoin and interact with a DeFi protocol for yield, like Curve. You know, I got a bunch of Bitcoin on Curve right now, and it's Bitcoin because I could liquidate my LP position and convert it from WBTC or REN BTC to real BTC, probably in about 15 minutes, 10 minutes, depending on 30 Ethereum block confirmations. And those UTXO assets are there, in stored across the dark nodes that are deployed and secured by the gray core currently. Obviously, again, to that whole decentralization talk of where Ren is going with its subnet release schedule. So, but point being, when you're allocating value to these platforms that produce yield, we really need to assess risk reward. And I see a minimized risk profile associated with the centralized organizations because they are registered and licensed and have custody and they're making profit. It's a great business model. So I see a relatively risk minimized analysis there. Now, there is risk associated with Curve, particularly because it's a smart contract platform that has a DAO that it's built on Turing complete smart contracts. So there's risk there in the actual integrity and execution of sophisticated code, and that's meaningful. So you have to assess your risk. I wouldn't take everything and put it into any one thing. And the whole point is, this is where diversification comes in. But don't go all in and don't spread too thin. So I get tempted, and believe me, this is where the FOMO kicks in. It's not FOMO, but it's just tempted for gains and just hungry, and that's the greed component. So I'm tempted to mint more WBTC and REN and allocate it towards the REN liquidity pool on Curve, because that'll produce. Let's go over here. Let's go over to Curve, because that produces significant yield. So that's producing 13.23%, which is so this is much more sophisticated than like yield that's produced by Aave, Compound, Celsius, and BlockFi, because this yield is not from interest payments on a debt. 2.9% is today's yield, not the yearly average yield, from a transaction fee, which is a culmination, an accumulation of the difference between what someone transfers in and what someone gets out. So this is the transaction fees. So I'm getting 2.9% today, over the course of a year. But so point being, it's kind of but so there's dilution involved with regard to Curve, but I am getting 13% as the dollar denominated value of Curve is producing 13.23% per year for today. Now, let me think about your question. So there's very different yield associated with a Revenue dark node versus a Curve liquidity provider. As I said, there's risk associated with the smart contracts. You can just buy Curve and lock it for VE Curve. And here's a nice metric where $1 in CRV for 4 years is equal to $139 as a liquidity provider. So that's the equivalence. It's a very interesting mathematical observation. So we're getting a certain amount of yield denominated in CRV, which has also a Bitcoin value, which also has a dollar value. So it's a couple of hops there, so 13.23%. But I'm also getting a portion of trading fees if I take CRV and lock it as VECRV. So I'm getting 84.5% on my VECRV. What does that mean? That means if I have one VECRV, if I have 100 VECRV, I am getting 84.5 CRV on a yearly basis. And I am getting that from 0.02% of all transaction fees of the platform. So this is obviously a very sustainable source of yield. It's coming from the transaction fees of the platform. And that was enacted by the DAO about a month ago, where 50% of the 0.04% transaction fee will be allocated towards VECRV holders. Now, it gets complicated. Not that everything I just said isn't complicated, because CRV has emissions, which means on a daily basis, more VECRV can be minted, which means there's dilution to VECRV, which is your proportional ownership, basically, of the transaction fees of the platform. So there is incentive to probably provide liquidity. And for myself also, I provided liquidity historically, so I have vesting and these are producing CRV, and I have vesting, which is producing CRV, which I could then apply to mint more VECRV in the effort to maintain as best I can my proportional ownership of the platform's transaction fees, because that's what VECRV is. It gives you a proportional ownership of the platform's transaction fees. And that's incredible, because this thing could be doing 10, 15, 20 billion dollars a day in the coming years. And if you have 0.001% of VECRV ownership, you're doing something right. If you're doing billions of dollars a day in transaction fees. So let's put it this way. I have 21,980 divided by 19,024,338. So I own 0.112,115 of VECRV. And if they're doing 10 billion, I'm going to try and hold on to that the best I can. Because if this number here, what is it, 0.115, check this out. So let's say the daily transaction fees was 10 billion and the daily earnings was $2 million. Calculated 2, 1, 2, 3, 4, 5, 6 times 0.00115. So if there was a that would be $2,300 a day in earnings. So that I'm going to try as hard as I can to retain my proportional ownership of VECRV because the speculative bet is that daily earnings is going to be $2 million a day instead of $22,000 a day. That's the bet. So, but it's hard, Lewis. It's hard because this is competitive. This isn't Ren where you own a virtual machine. This is you have to combat the dilution of your VE curve position. So there will be active management involved in maintaining the integrity or the meaningfulness or the potential for your VE curve position. Anyway, that's very complicated because and curve is relatively complicated because of that. Okay, 22 minutes into the stream. Who else is in the stream today? We got Barry's in the house. Always a pleasure. Jay Young, my man. And Barry says Bitcoin is pumping. Let's take a peek. Bitcoin dominance. We talked about it briefly earlier, but let's take a look at the Bitcoin chart. I want to take a look at this beauty again and see where we're at. We're inevitable to see some retrace. Oh, look at that. Look at that. Look at that. So this green line was a big deal. This green line was this support. Um, if you scroll out, you'll see, and here's the other supports. And so we're in price range of August 2019. You know what was going on in August 2019? The market was on fire. There was no um, uh, there's no repo operations yet with the collapse of the financial system in September 2019. Oh my goodness. Oh my good. It was actually this is right before the collapse of the United States financial system in 2017, and then the Federal Reserve bailed them out with repo operations. Um, Incredible. So look at this. I'm just excited. 12,750 is our current price point. You guys know where this is heading. The appropriate thing to have done is what we discussed over the last month and a half, 2 months. September was risk off. I made very clear mention on the stream when it was risk off. We saw it. We saw it clear as day in the 24-hour gainers on CoinGecko. It was very obvious. Well, the market, look at this market, 6.3% on Bitcoin. Reserve rates doing a rip. Good for them. You know, maybe it's because of Curve and the meta pool. Nope, no volume. So it's good for them. But you know, what's so the long-term holders? Sure, they're happy, but you could. This is not something you could have bet on for trading. It's not like you wait for it to fall back another 5-10%, and then in 2 days you pile in, you get another 20%. That market was April, May, June, July, August. About 4 months, we had complete irrational exuberance this year. We had total 2017 FOMO. It was crazy. It was DeFi mania. It was throw 100 grand in, you're going to get 20 grand in 2 days, a 20% rip on Aave, 20% rip on Bancor, 20% rip on Kyber Network. It was 20% rips all over the place, and it was just pretty much. Here, let's take a look at the chart. Let's take a look at one. Let's take a look at Ren, because these were 20% rips. After 20% rips, people probably made millions of dollars off this asset. And Kyber, and Bancor, and Aave. Aave was just up huge. Huge. I mean, look at this. And these are the daily candles. Rip, 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 day in, day out. And then more rips. Oh, it was so good. And it was starting here, May. maybe even a little earlier. You get some rips back here at the beginning of the year. But I started seeing the rips happen in the DeFi space starting in May. Absolutely incredible what gains to be had. So the point was that was the time for gambling. That was the time for risk on. That was the time to take Bitcoin, convert it into WBTC, and allocate it to or not necessarily the that path. You could point being that was the time to allocate value towards altcoins to get 20%, 20%, 20%. But then you had to take your profit into Bitcoin. And why? To be prepared for exactly now. This is why I've said risk off. It's risk off because Bitcoin's going to rip. And the Bitcoin dominance is broke. The trend line is broke. This is exciting. I think Bitcoin's going to scream. But I also think there's a couple of alts that are out going to outperform, and those are the alts that I hung on to. I hold on to Ren. I have my dark nodes because I'm not interested in the Ren coin directly. If Ren, so I bought my Ren for X amount of dollars, and I have three dark nodes. If my big Ren position went down 90%, but my revenue went up 10x, it's still the most incredible winning trade ever. I care about yield. I don't care about necessarily the assets price, but bear in mind they have the very sophisticated game theory where the for a properly decentralized deployment of dark nodes, you need the asset price to appreciate to account for the total TVL on the network, and the transaction fees have to incentivize people to not liquidate dark nodes and all that fancy complexity we've been talking about over the last couple months. Point being, this is not the time to start repositioning your portfolio. We should have been risk off for well over a month now, 2 months, beginning of September, September 2nd. It was that Thursday. I've said that Thursday, and I'll say it again. It was that Thursday. I don't remember which one, but it was that Thursday, and it was very obvious, clear as day. Stack the Bitcoin. So I was able to pull out about 155% gain on Bitcoin this year. So I had X amount, and now I had 2.5 as much. The FOMO is real right now, Mock Mock. Institutional FOMO because of the macro narrative, because of Raoul Pal's narrative. And it's not his narrative. He's telling a story of a narrative that's actually playing out. And it turns out that what he's telling, the story that he's telling, is really good. And it's spot on. And he's very much reflecting and representing the sequence of events that's playing out. And Michael Saylor, his narrative and his participation has definitely lit a match. And PayPal's in on the mix, and Square's in on the mix, and the institutional and the corporate treasury FOMO is going to be real. And guys, that's going to the Bitcoin narrative. And I don't. I am a fiscally conservative person, and they have destroyed the global financial system by printing trillions of dollars. But if these boys dare to print $2 to $4 trillion, do you have any idea what's going to happen to Bitcoin? They're going to. This is going to be the most incredible opportunity, not just of a lifetime, but of the millennium. If they print $2 to $4 trillion, oh my God! Lewis, no mo FOMO. That's what I like to say, my man. Big question. Do you envision centralized banks coming into crypto and specifically using RemVM for their own platform? I don't know. That's speculative to say the least, but I know the CBDCs would be awkward if they're not interoperable with the public blockchains, particularly because there's use for spending of CBDCs in the public blockchain. So I would think that they want interoperability so that their asset that the central banks want to create can be used. And that makes sense to me. So I don't know if REN will be the solution for their interoperability. The odds are the government's going to want to roll their own or be in control of something. They always want to be in control of something, but they're going to want to get those assets to be consumable in as many places as possible because the more places that the CBDCs can be used, the more power that the governments have. And that's why the dollar in the United States was so powerful for so many years because it could be used everywhere. It was used by everyone, but now that's changing. That's coming to an end. The dollar killed itself because the dollar cannot sustain the world. They can't print. They would have to print between the derivatives market, which is a quadrillion plus dollars, and the euro dollar market, which is unknown quadrillion dollars. They'd have to print like $100 trillion or more to give the amount of dollars that are desired and demanded by the rest of the world to prevent deflationary pressures, which is where other countries print to base their currency to buy dollars. And as you buying dollars, buying dollars, buying dollars in Forex, that deflates the price. That jacks up the price relative to other fiat around the world. So there's your dollar deflation, and if you're in another country, that's your inflation, where the value of your dollar is decreasing relative to the dollar. But that's a whole, it's very complicated. And the whole inflation word, I'm going to end on this note. The whole inflation word is relative. Nobody says, well, everyone says, are we having inflation? No, inflation and deflation are relative to something specific. Are we having inflation in food prices? Are we having inflation in car prices? Are we having inflation in technology? Technology is extremely is it inflationary? The prices are going down. Very strong competitive price that puts huge pressure on the price action. And CPI is relatively low. So there's whatever. I don't know. I don't want to start this whole conversation now. But inflation and deflation are relative. It's not just broad. So that's something that's important. If you get into a conversation about it and someone says, we're going to have inflation, you can now say, inflation in what? So if you have inflation in the dollar and you have deflation in food prices and you have inflation in housing prices, so it's relative to something. Just remember that. All right, ladies and gentlemen, 12:02 on a Wednesday afternoon. Bitcoin is rip-roaring, risk off, diversify, protect your gains, maximize your yield, and now is the time not to FOMO, not to make adjustments to your portfolio, maybe a little bit of last-minute tweaks, but now is the time to sit back, relax, watch CNBC for stimulus talks. And frankly, the lack of correlation between equities and Bitcoin, so equities are down or bearish today, and Bitcoin is just ripped the $400 candle. Fascinating. So sit back and relax. If they print some money, if they print a couple trillion, crypto is going to light off like a rocket ship like you've never seen. So enjoy your day. No more FOMO. Thank you all for joining. Smack those thumbs up button. Tell everyone to subscribe, and I wish you all a good one, and I'll catch you tomorrow. Peace.